Hello everyone, welcome to the 92nd episode of me learning how to trade in Forex. So in the last video we went through what is a carry trade, basically involving interest rate differential, so borrowing or selling a financial instrument with a low interest rate and then using that to purchase a financial instrument for high interest rate, and the profit is the interest rate differential. And it gives that example for an interest rate differential. Leverage carry trade example, basically the same as the example above, but you borrow a bigger amount of money. So yeah, that's it. And yeah, that's it. So now we're on to what is a currency carry trade. So what is a currency carry trade? Date is the 1st of April. So what is a currency carry trade? In the Forex market, currencies are traded in pairs. For example, if you buy USD CHF, you're actually buying the US dollar and selling the Swiss francs at the same time. You pay interest on the currency position you sell and collect interest on the currency position you buy. Right, okay, so in the Forex market, currencies are traded in pairs. You pay interest on the currency position you sell and collect interest on the currency position you buy. What makes a carry trade special in the spot Forex market is that interest payments happen every trading day based on your position. Technically, all positions are closed at the end of the day in the spot Forex market. You just don't see it happen if you hold a position to the next day. Brokers close and reopen your position, and then they debit/credit you the overnight interest rate differential between the two currencies. This is the cost of carrying, also known as rolling over a position to the next day. So, carrying, also known as rolling over a position to the next day means brokers closed and reopen your position and debit/credit you the overnight interest rate differential between the two currencies. The amount of leverage available from Forex brokers has made the carry trade very popular in the Forex market. Most Forex trading is margin based, meaning you only have to put up a small amount with the position and your broker will put up the rest. Many brokers ask as little as 1% or 2% of a position. Currency carry trade example. Let's take a look at a generic example to show how awesome this can be. For this example, we'll take a look at Joe, the newbie Forex trader. So this is Joe right here. It's Joe's birthday, and his grandparents, being the sweet and generous people they are, gave him $10,000. Sweet. Instead of going out and blowing his birthday present on video games and posters of bubblegum pop stars, he decides to save it for a rainy day. Joe goes to the local bank to open up a savings account, and the bank manager tells him, "Joe, your savings account will pay 1% a year on your account balance. Isn't that fantastic?" Joe pauses and thinks to himself, at 1%, my $10,000 will earn me $100 in a year. Man, that sucks. Joe, being the smart guy he is, has been studying babypips.com's School of Pipsology and knows of a better way to invest his money. So Joe kindly responds to the bank manager as, "Thank you sir, but I think I'll invest my money somewhere else." Joe has been demo trading several systems, including the carry trade, for over a year, so he has a pretty good understanding of how Forex trading works. He opens up a real account, deposits his $10,000 birthday gift, and puts his plan into action. Joe finds a currency pair whose interest rate differential is plus 5% a year, and he purchases $100,000 worth of that pair. Since this broker only requires a 1% deposit of the position, they hold $1,000 in margin with 100 to 1 leverage. So Joe now controls $100,000 worth of a currency pair, and that is receiving 5% a year interest. What will happen to Joe's account if he does nothing for a year? Well, here are three possibilities. Let's take a look at each one. Currency position loses value. The currency pair Joe buys drops like a rock in value. If the loss brings the account down to the amount set aside for the margin, then the position is closed and all that's left in the account is a margin minus $1,000. The pair ends up the same exchange rate at the end of the year. In this case, Joe does not gain or lose any value in his position, but he collected a 5% interest in the $100,000 position. This means on interest rate alone, Joe made $5,000 off of his $10,000 account. That is a 50% gain. Sweet. Currency position gains value. Joe's pair shoots up like a rocket, so not only does Joe collect at least $5,000 interest on his position, but he also takes home any gains. That would be a nice present for himself for his next birthday. Because of the 100 to 1 leverage, Joe has the potential to earn around 50% a year from his initial $10,000. Here an example of the currency pair that offers a 4.4% differential rate based on the interest rate in September 2010. Buy AUD, sell JPY, so AUD JPY, enter long AUD JPY, receives 4.5% from long AUD position, pays 0.10% from short JPY position, profit 4.40% in interest rate spread if spot rate remains constant. If you buy AUD JPY and held it for a year, you would earn a positive carry of plus 4.4%. Of course, if you sell AUD JPY, it works the opposite way. So instead of plus 4.4%, you basically get minus 4.4%. If you sold AUD JPY and held it for a year, you would earn a negative carry of minus 4.4%. Again, this is a generic example of how the carry trade works. Any questions on the concept? No? We know you could catch on quickly. Now it's time to move on to the most important part of this lesson, carry trade risk. Right. So carry trade risk. Carry trade risk. Oh no. Know when. Never mind. That's not the title. Know when carry trades work and when they don't. Why do carry trades work? When do carry trades work? Carry trade works best when investors feel risky and optimistic enough to buy high yielding currencies and sell low yielding currencies. So carry trades work best when investors feel risky and optimistic enough to buy high yielding currencies and sell lower yielding currencies. Half full, awesome. Half empty. It's kind of like an optimist who sees a glass half full. Whilst the current situation might not be ideal, he is hopeful that things will get better. The same goes for carry trades. Economic conditions may not be good, but the outlook of the buying currency does need to be positive. economic conditions may not be good, but the outlook of the buying currency does need to be positive. If the outlook of a country's economy looks as good as Angelina Jolie or Brad Pitt, then chances are that the country's central bank will have to raise interest rates in order to control inflation. This is good for the carry trade because a high interest rate means a bigger interest rate differential. If the outlook of a country's economy looks good, then there's a higher chance of that country's central bank raising the interest rates to control inflation, meaning there's creating a bigger interest rate differential. When do carry trades not work? On the other hand, if a country's economic prospects aren't looking too good, then nobody will be prepared to take on the currency. Especially if the market thinks the central bank will have to lower interest rates to help their economy. Carry trades won't work when a country's economic outlook doesn't look good. Therefore, the central bank could lower the interest rate to help their economy. Especially if the market thinks the central bank will have a low interest rate. To put it simply, carry trades work best when investors have low risk aversion. Carry trades do not work well when risk aversion is high, i.e. selling higher yielding currencies and buying back lower yielding currencies. Therefore, decreasing the low interest rate differential carry trades don't work well when risk aversion is high. Which is selling higher yielding currencies and buying lower yielding currencies. Buying back lower yielding currencies. When risk aversion is high, investors are less likely to take risky ventures. Let's put this into perspective. Let's say economic conditions are tough and the country is currently undergoing recession. What do you think your next door neighbour would do with his money? Your neighbour will probably choose a lower paying yet safe investment, then put it somewhere else. It doesn't matter if the return is low as long as the investment is a sure thing. Finding yield is not the priority anymore. Preserving principal is. This makes sense because this allows your neighbour to have a fallback plan in the event that things go bad, like if he loses his job. In the Forex jargon, your neighbour is said to have a high level of risk aversion. The psychology of big investors isn't that much different from your next door neighbour. Risk aversion refers to when traders unload their positions in higher yielding assets and move their capital in favour of safe haven currencies. This normally happens in times of uncertainty. So risk aversion is when traders unload their positions in higher yielding assets and move their capital in favor of safe haven currencies. This normally happens during times of uncertainty. When economic conditions are uncertain, investors tend to put their investments in safe haven currencies that offer low interest rates like the US dollar and the Japanese yen. This is the polar opposite of carry trades. This inflow of capital towards safe assets causes currencies with low interest to appreciate against those with high interest. This is the polar opposite of carry trade. Towards safe assets causes currency with low interest to appreciate against those with high interest. Right, okay. Yep. Carry trade criteria and risk. So, carry trade criteria and risk. Let's go over the criteria for a carry trade. It's pretty simple to find a suitable pair to do a carry trade. Look for two things. Find a high interest rate differential and find a pair that has been stable or in an uptrend in favour of the higher yielding currency. This gives you the ability to stay in the trade as long as possible and profit from the interest rate differential. Right, okay, so 2 points when trying to find a currency pair to carry trade. Find a high interest rate differential. Find a high interest rate differential. Find a pair which has been stable or in an uptrend in favor of the higher yielding currency. Pretty simple, huh? Let's take a real life example of the carry trade in action. So, from 2009 to early 2010, this pair has gained approximately 3,250 pips. The uptrend and interest rate differential of the pair has made it a nice investment during this period. This is the weekly chart of AUD/JPY. During this time, the Bank of Japan had maintained a zero interest rate policy, with the interest rate near zero at 0.10%, also known as ZERP. With the Reserve Bank of Australia touting one of the higher interest rates among the major currencies, 4.5% in the chart example, Many traders flock to this pair, one of the factors creating a nice little uptrend in the pair. From the start of 2009 to early 2010, this pair moved from the price of 55.5 to 88. That's 3,250 pips. If you couple that with interest payments from the interest rate differential of the two currencies, this pair has been a nice long-term play for many investors and traders able to weather the volatile up and down movement of the currency market. Of course, economic and political factors are changing daily. Interest rates and interest rate differentials between currencies may change as well, bringing popular carry trades such as the yen carry trade out of favor with investors. Right, okay, so, economic and political factors are changing daily. Therefore, interest rates and interest rate differentials between currencies may change as well. Bringing popular carry trades out of favor with traders. Carry trade risk. Because you are a very smart trader, you already know what the first question you should ask before entering trade is, right? What is my risk? Correct. Before entering a trade, you must always assess your max risk and whether or not it is acceptable according to your risk management rules. Before entering a trade, always assess the max risk and whether it's acceptable or not according to the risk management rules. In the example at the start of the lesson with Joe and the newbie Forex trader, his maximum risk would have been 9,000. His position would be automatically closed out once his loss hits 9,000. Eh? That doesn't sound very good, does it? Remember, this is the worst possible scenario and Joe is a newbie, so he hasn't fully appreciated the value of the stop loss. When doing a carry trade, you can still limit your losses like a regular directional trade. For instance, if Joe decided that he wants to limit his risk to 1,000, he could set a stop order to close the position at whatever the price level would be for that $1,000 loss. He will still keep any interest payments he received while holding onto the position. Stop loss can still be used in a carry trade. Right. Summary. Carry trade. A carry trade is when you borrow one financial instrument like the USD currency and use that to buy another financial instrument like JPY currency. While you are paying the low interest rate on the financial instrument you borrowed/sold, you are collecting high interest rates on the financial instrument you purchased. So a carry trade is when you are paying, or when you're selling, when you're paying the low interest rates on a financial instrument you borrowed/sold and collecting higher interest rate on a financial instrument you bought. Your profit is the money you collected from the interest rate differential. Profit is the money collected from the interest rate differential. This is another way to make money in the Forex market without having to buy low and sell high, which can be pretty tough to do day to day. Carry trade involves borrowing or selling a financial instrument with a low interest rate, then using it to buy another one with a high interest rate. Carry trades work best when investors feel like taking on risk. Current economic conditions need not to be good, but the outlook does need to be positive. Carry trades work best when investors feel like taking on risk. Current economic conditions doesn't need to be good, but the future outlook does need to be positive. If a country's economic prospects aren't looking too good, then nobody would be prepared to take on the risk. To put it simply, carry trades work best when investors have low risk aversion. Carry trades do not work well when risk aversion is high. When risk aversion is high, investors are less likely to buy higher yielding currencies or likely to reduce their positions in higher yielding currencies. So don't work when risk aversion is high. As investors are less likely to buy higher yielding currencies or likely to reduce their positions in higher yielding currencies. When economic conditions are uncertain, investors tend to put their investments in safe haven currencies, which tend to offer lower interest rates like the US dollar and the Japanese yen. It's pretty simple to find a suitable pair to do carry trade. Look for two things, right? So, when economic conditions are uncertain, investors tend to put their investments in safe haven currencies, which tend to offer lower interest rates. It's pretty simple to find a suitable pair to do a carry trade. Look for two things: find a high interest rate differential, find a pair that has been stable in an uptrend in favour of the high yielding currency. Two things when trying to find the currency pair to carry trade. Find a high interest rate differential and find a pair which has been stable or in an uptrend in favor of the higher yielding currency. It's literally written right here, so always remember that economic and political factors are changing the world daily. Remember that economic and political factors are changing the world daily. Therefore, interest rate differentials between currencies may change as well. So when doing a carry trade, bringing popular carry trades such as the yen carry trade out of favor with investors. So when doing a carry trade, you should still limit your losses like a regular directional trade. When doing a carry trade, still use still limit your losses like a regular directional trade. When properly applied, the carry trade can add significant income to your accounts along with your directional trading strategies. Cool quiz. Interest rates drive the financial markets, and that can't be any truer than in the currencies. How much do you understand about how this works, and what strategies can be used to make an extra profit? Carry trade. Oh no. If you pay 3% on a short NZD position and receive a 0.10% on the long JPY position, you have a... So you're selling you're selling a high interest rate currency to buy a lower interest rate currency. This is a negative carry, isn't it? A negative carry of 2.9% because yeah. Let's say you borrowed 50,000 from the bank at an annual rate of 3.5%. Immediately after that, you use the money to buy yourself a nice little bond that pays 5% a year. How much would you profit in a year? So it's 5% minus 3.5%, so that's 1.5% or $750. Carry trades do not work well when risk aversion is high. You can make the most profit from a carry trade when the lower yielding currency is trending higher against the higher yielding currency. The higher yielding currency is trending higher against the lower yielding currency. The high yielding currency is trending lower against the lower yielding currency. The currency pair is ranging sideways. It's when the higher yielding currency is trending higher against the lower yielding currency. When economic conditions are uncertain, investors tend to retreat to safe haven currencies. Which of the following should you look for in a carry trade? A high interest rate differential. True or false? With a carry trade, it's possible to profit even when the price of a currency pair is flat and stable. True, because of the interest rate differential. When you buy Euro USD, you are basically selling euros and buying US dollars, borrowing in euros and buying, selling US dollars and buying euros and US dollars. It's the first one or the third one. Selling euros, no, you're buying euros. A carry trade involves selling an asset and paying interest at a relatively something rate, so that you can buy another asset and receive something rate. Selling asset and paying interest at a relatively low rate, so that you can buy another asset and receive a higher interest rate. If you receive 4.75% from a long AUD position and pay 0.25% on a short CHF position, you have a positive because your long position is higher than your short position. So it's either one of the last two, but it's differential, you just take one away from each other, so 0.25 minus 4.75, 5%, positive carry 5%. Oh no, see the other 4 point. I think it's the other one. Oh no, I forgot. It was 4 point positive carry trade of 4.5%. That should be the right answer. Yep. Okay. Next one. The global role of the US dollar. The global role of the US dollar. So we're on to the US dollar index. Undergraduate, sophomore. The US dollar holds a unique position in the world of finance and trade, serving as a cornerstone of the global economy. Its status as the primary international reserve currency, medium of exchange, and unit of currency for a vast range of transactions has far-reaching implications for governments, businesses, and individuals alike. In this lesson, we'll learn the key aspects of the dollar's global role and explore the factors that contribute to its enduring appeal. Historical foundation: the Bretton Woods system. The origins of the US dollar's global dominance can be traced back to the 1944 Bretton Woods Conference, which aimed to establish a new monetary system to promote international trade and economic stability after World War II. As the United States controlled 2/3 of the world's gold reserves at the time, the US dollar became the anchor currency for the Bretton Woods system. The United States controlled 2/3 of the world's gold currencies at the time. Uncle Sam was basically the greedy leprechaun, hoarding all the world's gold in his pots. Consequently, countries pegged their currencies to the dollar, which was itself convertible to gold, making it the primary medium of exchange for international payments. Countries pegged their currencies to the dollar, which was itself convertible to gold. Why the dollar remains popular in the post-Bretton Woods era. Although the Bretton Woods system collapsed in the 1970s, the US dollar retained its status as the world's premier currency. This enduring appeal can be attributed to several factors. Economic stability. The Federal Reserve's efforts to control inflation have contributed to dollar stability, making it an attractive store of value and medium of exchange. Network effects. The widespread use of the dollar in international transactions has created a self-reinforcing cycle, with more individuals and businesses choosing to use the currency because of its widespread acceptance. Size and openness of the US financial markets. No other market comes even close. The depth and liquidity of the US financial markets enables large transactions that smaller markets might struggle to accommodate, further enhancing the dollar's attractiveness. At the end of the day, people want to keep dollar assets because the economic, political, and institutional fundamentals of the United States provide confidence and credibility. Right, several factors. Dollar status as the world's premier currency is due to economic stability, network effects, size and openness of US financial markets. The US dollar as a reserve currency. One of the most critical aspects of the US dollar's global role is its function as a reserve currency. A reserve currency is a currency held by the central banks in significant quantities. Right, US dollar is the world's reserve currency. A reserve currency is a currency held by central banks in significant quantities. No, quantities. It is widely used to conduct international trade and financial transactions, eliminating the cost of settling transactions involving different currencies. Central banks around the world hold a significant portion of their foreign exchange reserves in dollars, which they use to stabilize their own currencies. finance international trade, and provide a cushion against economic shocks. Today, central banks hold about 60% of their foreign exchange reserves in dollars. Even though the dollar's share of the central bank's foreign exchange reserves has gone down over the years, it's almost twice as much as the euro, yen, pound, and the yuan combined. It's still almost twice as much as the euro, yen, pound, and yuan combined, which is the same as it was a decade ago. The euro, which is its closest rival for the role of the world currency, makes up about 20% of the central bank reserves. The dollar's stability and widespread acceptance makes it an ideal choice for this purpose. Commodities pricing and the US dollar. The US dollar also plays a crucial role in global commodities markets, such as many commodities such as oil and gold are priced in dollars. This pricing mechanism simplifies international trade by providing a common benchmark and reducing the need for multiple currency conversions. It also underscores the close relationship between the dollar's value and commodity prices, with fluctuations in the currency's strength often impacting the cost of raw materials and finished goods. So dollars has a close relationship with commodities such as oil and gold. So fluctuations in the currency's strength often impacts the cost of raw materials and finished goods. The US dollar's impact on global trade and finance. The dollar's global role has significant implications for international trade and finance. Most currencies are only used within their own country or in cross-border transactions that directly involve the currency's issuer. However, the dollar is widely used for funding, pricing, and trading, invoicing, and settlement, and cross-border borrowing and loans even when the US is not involved. So, dollar is widely used for funding, pricing, trade invoicing, and settlement, and cross-border borrowing and loans, even when the US isn't involved. Its use as a medium of exchange for cross-border transactions reduces currency risk and facilitates the flow of goods and services between countries. Additionally, the dollar's prominence in global finance makes it a key funding currency for governments, businesses, and individuals seeking to access international capital markets. About half of the international trade is invoiced in dollars, and about half of all international loans and global debt securities are denominated in dollars. As a safe haven currency, the dollar is the preferred currency for investors during major economic crises. For example, during the global financial crisis of 2008-2009 and the economic chaos caused by COVID-19 pandemic in 2020, investors rushed to buy US dollars dashed for cash because they thought the dollar would keep its value. This is where the dollar's real power comes from. It's not from how much foreign countries hold or use it for trade, but from its role as the go-to currency for international debt and as a safe haven for investors in times of trouble. Is a safe haven currency. Dollar's real power doesn't come from how much foreign countries hold or use it for trade, but from its role as the go-to currency for international debt and as a safe haven currency for investors in times of trouble. How the US benefits from the dollar's global role. As you've learnt so far, rumours of the dollar's deaths are way overblown. International role, the US dollar, world trade, global GDP, cross-border loans, international debt securities, FX transaction volume, that's really high, official FX reserves high, trade invoicing high, SWIFT payments high, of which offshore US dollar share of global markets US share. The dollar's global role benefits the United States in several ways. First, it lowers a borrowing cost, enabling the US government to finance budget deficits more affordably. Second, it increases the purchasing power of Americans by strengthening the dollar's value, allowing them to buy more goods and services from other countries. However, this advantage comes with a downside, as a strong dollar makes American exports more expensive, potentially leading to job losses in export-related industries. Lastly, the widespread use of dollar in international trade grants the United States diplomatic leverage, enabling it to impose financial sanctions on adversaries. Dollar's global role benefits US in lowering borrowing cost, increases the purchasing power of Americans, makes American exports. Borrowing cost, enabling the US government to finance budget deficits more effectively, increase the purchasing power of Americans, as the dollar's value strengthens, so can buy more goods and services from other countries. However, a stronger dollar makes American exports more expensive, potentially leading to job losses in export-related industries. Lastly, the widespread use of the dollar in international trade grants the United States diplomatic leverage, enabling it to impose financial sanctions on adversaries. Grants US diplomatic leverage, can impose financial sanctions on adversaries. The future of the US dollar's dominance. The US dollar has persisted as the world's main current reserve currency for the past 70 years, even though there have been a lot of big changes such as the end of the fixed exchange rates, trade and financial globalization, technological progress, and changes in geopolitics. While the US dollar's global role is currently secure, the US dollar's dominance may not be permanent. Factors such as uncontrollable inflation, a decline in the US shares of global economy and trade, excessive debt, or overuse of financial sanctions could undermine the dollar's desirability. As the global economic landscape evolves, the dollar's dominance may be tested with potential implications for trade, finance, and geopolitics. De-dollarization or de-dollarization is a process of reducing the reliance of the US dollar as a reserve currency, a medium of exchange and a unit of account in the global economy. Particular attention is paid to China's rising global economy and digital currencies such as Bitcoin. Regarding China, a recent example is the use of the Chinese yuan to pay for crude oil transactions, allowing countries to buy and sell oil without involving the US dollar. This is known as petro-yuan, which is similar to the petrodollars that were created in the 1970s when Saudi Arabia and other oil exporting countries agreed to price their products in US dollars. If another currency or group of currencies were to replace the US dollar as the world's dominant medium of exchange, the United States will lose the benefits it currently enjoys, whilst the countries of the new leading currencies would stand to gain. That said, when the pound lost its power, another currency was waiting in the wings to take its place. There is no one like that today. Okay. I'm going to leave this episode here. That was a really long history about the US dollar, but yep. So thank you all guys for watching this episode. In the next one, we're gonna carry on with the US dollar index with what is the US dollar index. So yeah, I will see you all in the next video. Goodbye.